From Gold to Bitcoin, a documentary on the evolution of money. What is money and why does it exist? Money exists because barter failed. Early human societies relied on direct exchange, goods for goods. But this system collapsed as economies grew more complex. A fisherman did not always need grain when the farmer needed fish. What societies required was a universally accepted medium of exchange, a store of value, and a unit of account. Over centuries, many objects attempted to fill this role: shells, salt, livestock, but only one consistently survived across civilizations: gold. Why did gold become money across civilizations? Gold was not chosen by decree. It was chosen by nature and consensus. It is scarce, does not corrode, is divisible, easily recognizable, and costly to extract. These properties made gold resistant to manipulation and artificial expansion. From ancient Egypt to the Roman Empire, from the Islamic caliphates to imperial China, gold and silver became the backbone of trade. Importantly, no central authority controlled gold production. Its scarcity enforced discipline on rulers and prevented reckless spending. In this phase of history, inflation was rare and usually linked to debasement when rulers diluted gold coins with cheaper metals. If gold worked, why was it replaced? Gold worked economically, but not logistically. As trade expanded globally, transporting and securing physical gold became dangerous, slow, and expensive. To solve this, merchants began depositing gold with goldsmiths and early banks for safekeeping. In return, they received paper certificates stating that the holder could redeem a specific amount of gold on demand. These certificates were not money themselves. They were claims on money. Over time, people stopped redeeming gold and began trading the certificates directly. Trust shifted from gold to paper, but only because the promise of convertibility remained. When did paper money stop representing gold? The critical shift occurred gradually, not suddenly. Banks observed that depositors rarely demanded all their gold at once. This led to a pivotal realization. Banks could issue more paper claims than the gold they actually held. This practice became known as fractional reserve banking. While initially profitable, it introduced a structural instability. Money was now created as debt, not as stored value. Every loan expanded the money supply without expanding real resources. This was the moment money became elastic and inflation became systemic. Why were central banks created? As banking crises became frequent due to overlending and bank runs, governments sought centralized control to stabilize the system. Central banks were created to act as lenders of last resort, regulate commercial banks, control money supply and interest rates. The most influential example is the U.S. Federal Reserve, established in 1913 after repeated financial panics. Although presented as a public stabilizing institution, central banks introduced a new reality. Money creation was centralized, and monetary policy became separated from democratic accountability. What was the gold standard, and why was it abandoned? Under the gold standard, currencies were directly convertible into gold at a fixed rate. This system limited government spending, as excessive printing would trigger gold outflows. However, wars exposed its weakness. World War I and World War II required massive government expenditure. Printing money became politically easier than raising taxes. Temporary suspensions of gold convertibility became permanent habits. In 1971, the United States officially ended gold convertibility under President Nixon. From that moment onward, global currencies became fiat money. Money backed only by government authority, not by a physical asset. What is fiat money, and why does it cause inflation? Fiat money has no intrinsic constraint. Its supply is determined by policy decisions, not natural scarcity. When governments spend more than they collect, they borrow. When debt becomes unmanageable, central banks expand the money supply to absorb it. This expansion reduces purchasing power. Prices rise not because goods become more valuable, but because money becomes less scarce. Inflation is therefore not accidental. It is a mechanism embedded in the fiat system. It transfers wealth from savers to borrowers, from the public to the issuer. Who benefits from inflation? inflation benefits. Governments, by reducing the real value of debt. Banks through interest-based lending. Asset holders, whose assets rise faster than wages. It harms wage earners, pensioners, cash savers. Inflation functions as a hidden tax, imposed without legislation and often misunderstood by the public. How did money become digital, and what changed? In modern economies, over 90% of money exists only as digital entries. Banks do not store your money, they record liabilities. This system enables efficiency, but also control. Accounts can be frozen. Transactions can be tracked. Access can be restricted. Ownership becomes conditional. Money shifted from being a bearer asset to a permissioned one. Why was Bitcoin created? Bitcoin emerged in 2008 during a global financial crisis triggered by excessive debt, opaque banking practices, and government bailouts. Its creator, known as Satoshi Nakamoto, proposed a system that removed trust from institutions and placed it in mathematics. Bitcoin introduced a fixed supply, 21 million, decentralized verification, no central authority, immutable transaction records. It was designed as a response to fiat instability, not as a speculative asset. How is Bitcoin different from traditional money? Bitcoin cannot be printed to finance wars or deficits. Its monetary policy is transparent and unchangeable without global consensus. Unlike bank money, Bitcoin ownership does not depend on permission. Control lies with cryptographic keys, not institutions. In economic terms, Bitcoin reintroduces scarcity into the digital age, resembling gold, but without physical limitations. Who controls money today, and who might control it tomorrow? Today, money is largely controlled by central banks, governments, large financial institutions. Bitcoin challenges this structure by offering an alternative system, not controlled, but governed by protocol. Whether it replaces fiat or coexists with it remains uncertain, but its existence has already changed the conversation. Final question: is this the end of monetary evolution? Money has evolved from gold, paper, debt, digital, cryptographic scarcity. Each transformation increased efficiency, but reduced individual sovereignty. Bitcoin does not claim perfection. It raises a question rather than offering a promise. Should money be controlled by institutions or by rules no one can alter? That question defines the future of money.